Yesterday at 5 p.m. when we closed the settlement price, and then when we opened up at 6 p.m., there's no difference in between those two prices. So there's no gap. So all I do is annotate that price because it'll still refer to it. And as you can see, we trade back up in. Where's it trading into also? What other confluence is there? Look close. There's two other things there. You have that gap, and then you have what I'm discussing here. Whenever you have wicks, you want to measure that. Okay? Here's the halfway point or consequent encroachment. This wick is allowed to go through it. Why? Because you have a fair value gap. But then look at this one here. What's the high of that? You're going to look right over here. Look up in the upper left-hand corner. What's the high of that candle right there? 19,096.50. That's exactly the consequent encroachment level of that wick. You're going to tell me that that's buying and selling pressure? Yeah. So when you're looking for entry patterns, when you're looking for targets for limiting out on partials or terminus, here's your 3/4 level traded to. Now, because of this, I want to see it respect this up close candle. In other words, don't trade above it. It can come back and touch it again. It's better if it doesn't. It leaves a little portion here. But I want to see it to explore now below this 830 news driver. That's what I like to see. But here, this wick trades up to cutting through candles because it's not supply and demand. We go right back to this wick right here. That candle's high to the tick gives us the actual high that you can anticipate as it's returning back into here. Why should that be reasonable? Two things. Number one, you have this wick here. Bear with me. I have to put the lipstick on this chart to show you what I want to see. So we have this wick here. We have this gap. It trades up to there. And also, what's to the left of this candle? The one that trades into the fair value gap, right? So isn't there a wick on this candle? Sure it is. So we have this wick on this candle inside of this fair value gap and this wick here. So when price was trading off of this target we were looking for and it rebounded off that, came back up into the fair value gap, it's reasonable for it to go up to the fair value gap high, which is this candle's low. This price right there on that wick, it's a premium array because you're trading back up to it. You extend that through, it's part of the fair value gap, and then the next candle trades up and touches it. We do not want to see, this is important, we do not want to see, if it's going to be bearish, we don't want to see that consequent encroachment of that wick. Once it's traded to here, once it trades back up to it there, we have this fair value gap that should send price lower or kind of keep it at bay, not trading it higher. So if this candle is trading back up to it, we are trusting the logic around this phenomenon saying that it's already done the work of trading to the high of the fair value gap. So half of the fair value gap, let's look at that. You can see it in here. It doesn't trade there. Notice that on this candle? It does not trade there. Is that a good thing or is that a bad thing? Think about what I've taught you. In this mentorship, I taught you that PD arrays, very specific levels that we're looking for, if they fail to be printed to, if they can't even return back to them, and you have a directional bias in concert with that level you're studying, if it can't go there, that means it's decidedly weak. And when you're bearish, that's a signature you want to see. But because we have this area over here, and because I'm not trading support and resistance, the support and resistance fellows would have been like, okay, here's where we stopped. So let's draw that line out in time. Well, we went way past that to some random up closed candle and created a wick, something random. We don't know why it went there, right? Support resistance folks don't have any idea why it did that, but you're learning it. It's this wick here. It trades up to it, completes and fulfills the role of buy-side delivery, which was inefficient on this candle. So the market has offered single pass to the downside. So this is sell-side delivery. That means price is going lower. Then it comes back up to re-deliver the inefficiency in this time of that one candle. What was it inefficient on? Delivery to the upside. So buy-side delivery. It offers it, stops to the tick, and then drops down. The next candle, if you're looking for support, if you're looking for swing highs and swing lows, you want to see it trade up into levels like this. It should hit that and stop. And also fail to trade to half of that fair value gap. That's a failure to get to consequent encroachment. We've already fulfilled 3 factors here. We traded up to finish in filling out this candle's low to the difference of this candle's high, which is that fair value gap right there. That's a SIBI, sell-side imbalance, buy-side inefficiency. We trade back to the 6 p.m. opening price. Why is that important? Because there's no gap between Friday, the 5 p.m. close settlement price and where we started trading for NQ. So because there's no gap, we just simply use the 6 p.m. opening price. I told you when we were up here, you're going to have it on your chart because it's going to be treated the same way. It'll trade through it and come back and treat it as a key level. It trades through it on a wick, which is reasonable because we're inside this fair value gap. But this level here, when we trade it back up to it, notice that the bodies in the candles do not trade and close above that wick. Consequent encroachment. See that? It's telling you that this candle backed off. So that means when I see something like that, I'm looking for the immediate next candle to do a lower high than this high. And I can frame everything on that fair value gap and where that consequent encroachment is on that wick, if it's there. You may not have a wick over here. Then you would just simply go into the details of simply using the 6 p.m. opening price, which is this dashed line, and the consequent encroachment of that fair value gap. So in other words, if this wasn't here, I would expect this to trade up to midpoint of the fair value gap. But if it doesn't and it trades down lower, I'll simply just go in short on the open and touching back this body right here, as it does there. So, and that could be easily done on a 15-second chart, a 30-second chart, a 5-second chart. You would see a little bit more detail in that difference between where we close on this 1-minute candle to where we open there. See that little run right there? Right off that fair value gap. Trades up into it, plummets, and the interest is below that low. So if it does this, we're going to see we're going to see a big candle like that expand lower. So isn't it fun watching somebody knows what they're talking about? Isn't it interesting instead of staring at the chart, not knowing what it's going to do? But I'm also giving you all kinds of information that are just gold, because this information, if you look for swing highs and swing lows, which is what we called a ring high and a ring low, because for instance, like this little candlestick high, it has a lower high to the left of it here, a high that's lower to the right of it than that one. So in other words, we have a candle that has a high that has a lower high to the left and a lower high to the right. So we call that a swing high. But on my chart, if this was a daily chart, I would put a little circle or a ring right above that. So that way, when I looked at my charts, I could map out market structure. I could see where we are in deference to previous swing highs and swing lows. And if I start seeing swing highs that are forming that are lower than a cluster of swing highs further back, then I know I'm probably part of an intermediate term price run, which is kind of like what I was hinting at here with going all this business here. We talked about it trading down to the midpoint when it was here. We were focusing there, but because we're looking for too much of a precision element, here's where you would have failed using an entry. You would not have been filled, but the market runs with you. Okay, if you couldn't get in there, then you can use this. You see that? Okay, say you couldn't get in here. but then you have the market come back up and trade into this candlestick here. We don't want to see it trade above that candle. There was a gap here, but it trades all the way back up, but it does not take out the high. See that? Trades right back to what? Consequent encroachment, that wick I talked about at 8:30. This could be your entry. This could be your entry. Let me test your memory and see if you kept good notes. What is this candlestick providing you in terms of an entry mechanism? I talked about it yesterday. I talked about it a lot if you've been my student for a while. But this candle right here, what is this candle when it traded there like that? What is that referred to? I'll give you a second when I take a sip of my water. Institutional order flow entry drill.